Good afternoon, everyone. Thank you so much for joining us for this webinar on passive ESG strategies for endowments. My name is Nicole Harmon. I'm a program manager with the Intentional Endowments Network, and I'm very pleased to have with me three great panelists to share their experience and expertise on this topic today. After our panelists give their presentations, we'll spend the remainder of the hour in dialogue responding to your questions. So please enter your questions throughout the presentation in the chat function of the control panel at any time, and we'll try to get to as many of them as possible. This webinar is being recorded. It will be distributed to all registrants by email and will also be available on our website shortly after it's completed. So you can refer back to this conversation and share it with others, and we will also make the slides available upon request. So just briefly before we dive in, for those of you that aren't familiar with the Intentional Endowments Network, we're a nonprofit collaborative peer learning network with the goal of supporting endowments in enhancing performance by aligning investments with institutional mission, values, and sustainability goals. And we do this in a variety of ways, including hosting in-person forums and events, facilitating peer networking, curating useful resources on sustainable investing opportunities, and providing educational venues such as webinars like this one. So we encourage you to stay engaged in these conversations after today's webinar. More information on IEN is available on our website. You can see the link on this slide, or you're welcome to reach out to us at any time. So with that, I will turn it over to Alex Bernhardt, Principal and U.S. Responsible Investment Leader at Mercer, and he will be presenting as well as moderating the discussion today. Alex?
Thanks very much, Nicole. I'm very, very pleased to have the opportunity to moderate this panel here today. We have two very distinguished panelists, Anil Rao, Executive Director of Equity Applied Research at MSCI, and Don Gould, who's a man of many hats, the Vice Chair of the Board of Trustees at Pitzer College, as well as the Chair of the Investment Committee there. And he's also President and Chief Investment Officer at Gould Asset Management. I had the privilege of working with both of these gentlemen on the ex-fossil fuels ESG index investment solution for Pitzer that we will be discussing in some detail here today. Before I hand over the reins to Anil, who will give us an overview of passive investing with an ESG lens, generally speaking. I thought it would be useful based on some of the feedback we received during the registration process to establish some context for this conversation here today. And to help with that, I've got a couple of small visuals, which we'll go through now. If you could advance the slides, please, Nicole, to the first one. Thank you. So when we use the term responsible investment at Mercer, and Mercer, for those of you who aren't aware, is an investment consultant, one of the largest in the world, and we advise investors of all types and sizes on all manner of ESG, environmental, social, and governance-related activities and actions. When we use the term responsible investment, we use it as an umbrella term which encapsulates a number of different approaches to investing responsibly. Affectionately known by their acronyms, which you can see in the upper half of this chart. So SRI investing is also referred to as socially responsible investing. Is typified most often by negative screening and an approach to active ownership, or rather engaging with underlying portfolio companies in a specific way. ESG investing, or ESG integration, sometimes it's referred to, is really more of an approach typified by positive screening, or actually simply incorporating ESG data points into the investment process alongside financial data points. And then impact investing is what I like to refer to as sort of a concentrated ESG investment thesis. The real focus there is on intention, so making sure that impact is a primary goal alongside financial return, or sometimes even primary to financial return for the investment decision. And then measurement of environmental and social impact of that investment over a long period of time is also essential. And so all three of those approaches constitute responsible investing. And we'll be talking a bit about all three of those today. But the focus of our conversation will be on this index solution, which we've developed collectively for Pitzer College. And you can see to develop these solutions, there are a number of types of different approaches that typically align with each of these approaches to responsible investment. You can see the bubbles on the bottom of the chart there show that SRI screened indices are often used to implement an SRI approach to investing. ESG enhanced indices and ESG integrated actively managed solutions are most often used to implement ESG integrated approaches. And then you also have sustainability themed strategies, both for public and private sustainability themed strategies, which can help to implement an impact orientation in a portfolio. And so again, we'll be talking about the first two, focusing our conversation today on the first two bubbles in that spectrum of index to active products here today. Next slide, please, Nicole. And additionally, what we're focusing on again is a solution that we have implemented, a portfolio solution that we've implemented for a unique institution in a unique circumstance. Generally speaking, there's a lot that goes on behind the scenes before you can get to a point in an investment process where such a decision can be made. At Mercer, we've developed what we call our foundation for our framework for sustainable growth, which we use as a foundation for addressing ESG issues, including climate change. And the framework has three simple steps, essentially: beliefs, process, and portfolio. And we inevitably work with clients when they want to integrate environmental, social, and governance considerations into their investment portfolio. We work with them to establish a set of beliefs as to how they believe these ESG factors will influence portfolio risk and return, but also how they might influence the organization's reputation. Once those beliefs have been established and ideally documented to make sure that they have some staying power, we'll then work to update investment processes to incorporate ESG considerations. So that can include, adding ESG as a dimension in your manager monitoring or selection process. It can involve monitoring the ESG performance of underlying portfolios using ESG data. There are a number of other ways that you can implement a responsible investment policy, if you will. And then on the portfolio side, once you've done the beliefs and process blocking and tackling, you can then start to work on portfolio activities. So that means assessing the risk of your portfolio to certain risks, ESG-related risks or exposures, rebalancing or reallocating your portfolio using a number of different tools. We'll talk again about one of those here today in detail, which is an enhanced ESG and enhanced and screened ESG index solution, but there are many others as well that could be utilized. And then also, looking at the possibility of engagement or being an active owner as a means of influencing systemic risk management solutions. And once you have this sort of governance framework in place, again with a strong foundation of documented beliefs and investment policies, you can then work on things like climate change risk in a more holistic way, and treat it as you would any other risk in a typical risk management process, which we've identified on the right hand side of that graphic there. So all that said, hopefully it provides some useful context for the conversation we're about to have here today. And so with that, I'm going to turn it over to Anil Rao, who's going to talk again about passive investing with an ESG lens. So Anil.
Great. Thanks, Alex. And thanks for the introduction. So as Alex said, my name's Anil Rao. I'm part of MSCI's Applied Research Group based in San Francisco. Maybe we can advance one more slide. So we're all on the same slide here. This should say at the top, the growth of equity indexing. So MSCI is a provider of investment decision support tools. These cover equity indexes, ESG research that we'll get into a little more, and also risk analytic tools. I think I'll just speak for a few minutes here on just what are some of the broader themes that are affecting our business and affecting investment management. I think we're all aware of some of these, be it funding ratios, a low rate environment, or the movement toward private assets. The growing importance of passive investing is one that we'll speak to over the next few slides and over the course of today's conversation. There are three large components within passive mandates. One of these on the left is the bulk of our business, and that's really driven by the trend away from home bias investing towards more global benchmarks or global frameworks. A second on the far right here is the trend toward factor or style-based investing, also called smart beta. And then third, maybe the fastest growing of all these three, is this rapid rise, as Alex mentioned, of environmental, social, and governance themed mandates. Let's move over to the next slide. ESG indexes are certainly in their early stage of adoption, but there are some ongoing initiatives in the major economic regions, whether it be the Americas, APAC, or Europe. I think generally there is a growing recognition of the fiduciary case for ESG integration, and climate change is acknowledged now by many financial regulators and by investors as a risk to certain assets and across the total portfolio. This slide has a couple of recent cases. For example, in Asia, the large public pension there is transitioning from market cap to ESG benchmarks for a portion of its domestic equity portfolio. I think endowments, we know, have been early adopters in divestment. Individual investors, and particularly millennials, are part of the early adoption curve as well. Let's move over to the next slide. This has a handful of some of the large and leading asset owners, specifically around the world, that have adopted and have made their intentions publicly known now, that have adopted whether it's ESG equity or fixed income indexes as benchmarks for a portion or broader pieces of their portfolios. As I mentioned, we believe this is the beginning of a larger trend where ESG research, that's stock level research, stock level ratings, and index construction become an integral part of the investment process. These, as I said, are just a handful of the larger asset owners that MSCI has been involved in terms of an index creation or an index adoption. We can speak to some of their investment objectives maybe toward the tail end of today's presentation. Let's move over a slide, please. At the heart of ESG indexes is really combining best practices in index construction. So that's something we've been doing now for about 30 or 40 years with stock level, that is our own ESG research. So that research team provides ratings and analysis of the environmental, the social, the governance related business practices of many global firms. And we can incorporate that rating as we would any other attribute or signal. So as we might incorporate a firm's country of operations or its valuation into a market cap weighted or a value oriented index, we can certainly incorporate a rating or some type of scoring into as a measure of long-term risk as well. So let's maybe talk about how we might do that. And we can start with the next slide. So I've just shown here the three pillars of what we consider the long-term risks that fall under the E, the S, and the G categories. And each of these are going to be made up of a handful of underlying metrics. One of the focus here is that the most relevant ESG factors will differ by industry. And secondly, we're going to focus on risk exposure and not just the disclosure. So the exposure is going to be based on what is a firm's level of exposure to some risk. And then it is going to be say the type of operations or the location or the size of operations, but also the risk management practices in place around that risk. So maybe a good example is if you can take a chemicals firm that has a highly water-intensive business and is also exposed to highly water-stressed regions, right? So it therefore has a high exposure. But if management has a reduction target in place or a low and improving water intensity, the firm would be rated higher on the water stress metric than an equivalent firm with no evidence of water management practices in place. So we're going to try to balance both the exposure and the management practices in place. And right now we provide ratings on around 6,400 companies globally. And those ratings will take effect, we'll see in a minute, into the index construction. Okay, if we move over to the next slide, there are various ways of incorporating that rating. The oldest form, I think Alex made a reference to this, is what we call values. So that's shown here on the top right. And that's still relevant to many investors today. So this approach typically involves screening out companies based on business activities. A second method, bottom right here, is the impact category. Okay, so that's going to capture approaches that aim to have, say, a positive impact by a positive screen, say, screening on source of revenues. The third, on the left here, is the integrated approach. And this is growing in importance as it addresses the investment objectives of long horizon investors, such as endowments and foundations. So the integrated approach attempts to maximize exposure to some ESG score, some overall portfolio level score that captures the risk and return characteristics of the universe of assets that it's created from. So it's going to capture the risk and return of the benchmark. And that's important because it can serve as a policy benchmark and reduce the underlying tracking error, which we'll get to in just a second. Okay, if we move over to the next slide, the integrated approach is bound by the benchmark, as we mentioned, and it's bound by the asset owner's policy. And in addition to that, there's this growing body of academic literature of ESG adding alpha. So that is that the ESG attribute of a firm or its management practices can be transmitted to returns via higher cost of capital, the volatility in earnings, or the accounting irregularities due to governance practices. So we've done some research on this. A study we released in 2015 looked at the effect of screening for the most highly rated ESG firms, in addition to firms that had an upward trend. That is, that they moved from, let's say, a mid-rated firm to a highly rated firm. So was there some return in ESG momentum? There's been a handful of other studies on this as well. We're now creating an index based off this also. Let me jump over to the next slide, actually 2 slides over. Great, thanks. So depending on the horizon of the investor and the tolerance for tracking error, the index could fit either into a core part of the equity program or the satellite. So we can think of the satellite as containing managers, whether they be active and passive, with generally a higher tracking error, more concentrated in maybe a higher thematic exposure. So the impact indexes that Alex had mentioned would fall under this satellite portion. The core would contain more passive allocations. And as we mentioned, we would want that to start from a broadly diversified universe, and the resulting portfolio would have a lower tracking error. In addition, exclusions, whether they be country and sector tilts, all of those could result in higher tracking error from the equity policy. So we would have to balance both the desire for a tilted portfolio with the unintended exposures, say, toward a certain country, toward a sector, toward individual names that are imposed on the portfolio. We have a couple of ways of doing this. If we jump over to the last slide here, and the title of this should say investment objective drives the index construction. The integrated indexes, that is the ones that are built from a broader universe, what they attempt to do is to increase the overall ESG quality of the index compared to its parent, right? And as we said, we have a couple of implementation methods. One method we have is just selection-based, right? For example, the ex-fossil fuel index, right, excludes constituents that have some proven fossil fuel reserves used for energy purposes, right? Or we might choose instead to positively screen for only those names that are the highest rated within certain sectors. So that's the selection-based method. A second method we have is optimization, right? So this will use typically a risk model and some mean variance optimization to maximize exposure to high ESG rated firms, subject to a tracking area constraint, sector constraints, individual name constraints, or country constraints. Lastly, we can reweight, right? So the reweighting method implements a minimum ESG standard with fewer exclusions, and then reweights the parent constituents based on a rating or some other factor such as ESG trend. So each of these different methods solves some portion of the portfolio problem, whether it be the construction of a policy benchmark or a more active portfolio. Don will, and I'll hand over to him here, will speak a little more to the index that Pitzer created, which actually combines two of these three methods. Don, if I could pass over to you.
Go ahead, Don. That would be great. Thank you.
Okay, thanks very much, Anil. So yeah, Pitzer College, I guess we're the case study here for people interested in how one university took on the whole question of ESG implementation. I thought it would be most helpful just to give you a timeline of how this all evolved. So if we could go to the next slide. First, a little bit about Pitzer. We're not a household name. We were founded in 1963. We're the youngest of the 5 undergraduate Claremont colleges. People pretty much know about Claremont. We're in Southern California. Pitzer is a small school, 1,000 students, a $135 million endowment. And Pitzer focused on social responsibility and environmental sustainability from pretty much its founding over 50 years ago. I like to say that Pitzer College was in left field at the time, and that the field has sort of moved such that we find ourselves closer to home plate, because the values that Pitzer has always espoused are, I think, pretty widely held now in the higher education world. Okay, if we go to the next slide. So the evolution of how we got to this fund that was launched just a couple months ago is as follows, and I've broken it into 2 phases, which I'll call phase 1 and phase 2. Phase 1 began in April of 2013 when, like many schools, Pitzer was approached by a largely student-led movement with a request to divest our endowment from fossil fuel stocks. And you know, like most people in my industry, my initial reaction to this as the incoming chair of the investment committee was resistant and a little bit skeptical, because none of us like to have our asset universe restricted. But I spent, you know, several months researching the issue and thinking about it and talking to people, and in particular thinking about it in the context of Pitzer. And what Pitzer was about, and ultimately went to the board in October of that year and said, you know, this is not an open and shut case. This is not something we can simply reject out of hand. We actually have to take a serious look at this request. And so the board chair established a campus-wide working group that included trustees, students, faculty, and staff to look at the question over the next 6 months. You know, I could give an entire talk on just the evolution of the thinking within the working group, but to sort of jump a little forward here for the sake of time, in April of 2014, the working group went to the board with a recommendation, which the board largely adopted almost exactly as proposed. And it had several planks, four of which I've listed here. One was that we would seek to divest the endowment of fossil fuel stocks in our public equity portfolio. We would go beyond, I guess, what Alex calls an SRI and Anil refers to as a values screen, which is the fossil fuels. We would go beyond that to try to integrate ESG factors into the entire public equity portfolio. We also wanted to go beyond the endowment. We figured this was an opportunity to get buy-in throughout the campus on a number of measures. One was to cut the carbon footprint of the campus by an additional 25% by the end of 2016, and to generally increase the focus on campus on sustainable practices. So what started as a simple request to divest from fossil fuels ultimately grew into a much bigger initiative. We were able, after April 2014, over the next several months, to actually cut the fossil fuel holdings from about 6% to 1%. And that wasn't actually too difficult. It required kind of measuring the different holdings that we had by their fossil fuel intensity and eliminating what you might call the low-hanging fruit. The last 1% was really challenging. It would have required essentially disrupting about 80% of the portfolio in order to eliminate a 1% holding, because we were primarily in commingled vehicles where we couldn't go in and remove a fossil fuel holding from that portfolio on our own. Okay, next slide, please. So I haven't listed much in 2015 here, but I will say that, you know, we started our conversations with Mercer at that point about primarily how are we going to integrate ESG into our portfolio. And we looked at a number of things, for example, looking at manager ESG ratings, and you know, a variety of different ways to get to this aspiration of integrating ESG. But they all kind of led us back to the same place, which was that they were highly labor intensive and probably not a good fit for a small endowment. You know, we're not Harvard. We don't have the Harvard Management Company. We don't have the Yale Endowment Office. We've got 5 or 6 volunteers who meet perhaps 3 times a year in person. But we have the same fiduciary duties as Harvard and Yale. And so we had to find a solution that actually was practical, given our resource constraints. And so ultimately in May 2016, we kind of took a different turn, which was, let's see if we can come up with what we'll call a passive solution that would meet our ex-fossil fuel objective and also our ESG integration objective. And so we sat down with Mercer with a blank sheet of paper, essentially, and I'll come to that in a minute as to what we wrote on that piece of paper. Ultimately, it led in August of this year to the launch of a fund by BlackRock, of which Pitzer is the founding investor, and in which we have our entire public equity portfolio. Next slide, please. So if you think about the blank sheet of paper that we had when we sat down with Mercer in 2016, this is essentially what we wrote on that piece of paper. We said, first of all, that we wanted a single global equity benchmark, and that in itself was, I think, a large achievement for us. I'll come back to that in a minute. We wanted an asset universe that started with that screen, that SRI values screen, which is that we did not want any fossil fuel stocks, which we defined as reserve owners who are primarily in the business of exploration, extraction, and or sale of fossil fuels. So we eliminated that from the public equity universe. And the remaining universe, we then wanted to apply an ESG integration to. We were quite insistent that the tracking error be measurable and be low, because I think, for obvious reasons, you can't have a whole lot of unpredictability in how something's going to perform, and fit that in with sort of the prudence required within the fiduciary framework that we operate in. We wanted low turnover, simply, to keep transaction costs under control. And I think this next one, is really what answers the question of how do we end up with a passive solution. We want a disciplined implementation. We want something where we know that the process by which stocks are picked and weighted is going to be consistent through time. And finally, low cost, which of course is not a new story, but certainly explains a great deal of the move in the direction of passive. Okay, next slide, please. So I have a couple slides here just to show you before and after kind of the impact on us. I say us, the college. I say us in particular, the investment committee of the board. Before we implemented this fund, we had 8 different funds or separate accounts that we were monitoring. That's been reduced down to just this single index fund. Of those eight funds or separate accounts represented 6 different asset classes. In other words, our global equity universe, we had split into 6 categories. And of course, now it's just a single global equity benchmark. Rebalancing within the equity portfolio was something we had to do at least annually. Currently, there's no need to rebalance because, in essence, this is a portfolio that is rebalancing itself through time. Manager evaluation, which is a very traditional function of your investment management consultant, was something that was constantly on our agendas. Since we meet 3 times a year, we were potentially looking at the performance of our managers as often as 3 times a year. How are they doing versus their benchmarks? Et cetera, et cetera. Now, it's a bit of an exaggeration to say we're never evaluating our manager. Obviously, we have to evaluate how BlackRock is managing this fund, but it's not the same kind of evaluation that one is conducting when you have certainly active managers and when you have so many of them. Next slide. The introduction of the fund in August allowed us to eliminate that last 1% of fossil fuel exposure, since we were beginning with an ex-fossil fuel asset universe. So we went from 6% down to 0. Our ESG integration previously was minimal. We had a few corners of the portfolio that perhaps gave some lip service to it, but of course now it's very comprehensive, and as I mentioned earlier, it's comprehensive in a disciplined manner. Carbon intensity, at least by one measure, dropped from 244, assuming that our portfolio was similar to MSCI ACWI previously, to 189 currently. Interestingly, going just from an ex-fossil fuel universe to an ESG optimized portfolio reduced the carbon intensity quite significantly as well. Tracking error dropped by about, well, you can see more than half. We specified a target tracking error of about 0.6% per annum, and that was based on sort of an efficient frontier analysis conducted by BlackRock and MSCI. Seemed to be the sweet spot, and certainly a number that we could live with on an ongoing basis. And finally, you can see that total expenses, which, by the way, don't reflect internal transactional expenses within portfolios, but just management fee explicit expenses dropped by more than half. Okay, next slide. I put in this slide, and I think this is my final slide, in part to bring attention to something I mentioned earlier, which is what kind of solution is practical for your particular institution? And so I made a list here of things we don't do anymore at Pitzer. We don't worry about active equity manager performance. We don't worry if a star portfolio manager has changed firms or retired. We don't worry about whether the managers are adhering to their style or not. All of these things are hugely time consuming. We don't do those anymore. We don't debate whether we should be overweight US versus international this year versus next year. And similarly, we don't debate or fine tune the allocations among all the different ways that you can slice the equity pie. And I just gave a couple examples here, growth versus value, or for example, size classifications. And finally, we don't go in front of the entire board 3 times a year, continuously doing this song and dance about why performance was either substantially above or substantially below benchmark. What this has allowed us to do, I think, is to allow the investment committee to really focus on the bigger picture issues. It's allowed us to allocate our scarce resource, which is time, to the issues that are most important to the institution. I think that covers it. The last slide is a photograph of a mosaic that's in one of our new buildings on campus. So I threw that in for artistic effect. I will pass it back over to you, Alex.
Thanks, Don. That was a great overview and a beautiful ending to your slides there. I wanted to thank you both, Anil and Don, for that contribution. It was very enlightening. For all of you on the line, you are able to insert questions into the webinar screen online. So please do so now if you have any that you haven't already posed elsewhere. I'm going to start off with a few questions that came through from the registrants, and which we had pre-prepared just out of interest. So Don, I know that you've been talking about this solution with a number of peer organizations and a number of venues around the country the last couple of months. I'm wondering have you had any feedback from peers so far, or maybe not peers in the endowment space, but other asset owners as well, about the solution that you've come up with, and has it been, what has it been? Positive, negative, mixed? Yeah.
I think there's been a lot of interest. I think the interest is both in, it's in 2 aspects, right? One is sort of the obvious, which is, well, if there's an institution that's interested in fossil fuel divestment and ESG, here we've come up with a pretty cost-effective and I think elegant solution to that. But I think there's also sort of the endowment governance aspect of it. We spent, I've been on the board 13 years, and I spent the first 11 and a half, kind of tearing out what hair I had left with this highly labor intensive process that I didn't think was resulting in better outcomes for the endowment. And so I think, as interesting as, and I know the focus here is, on the ESG and the social screen, the divestment, but I think there's a lot of interest in, is there a better way to, especially for smaller institutions like Pitzer, to oversee their endowment. And so there's been a lot of interest, I think, from that perspective as well.
That's great. So one other thing I noticed from your presentation, Don, is that this has effectively been a 4-year process from 2013 through now. So that's one interesting thing for participants, I think, to take away, is that this is not an overnight thing, a revolution. It's definitely much more of an evolution. But to that end, I'm wondering if you could speak to, you already spoke to the high level points of the timeline from 2013 to today. But is there a little bit of detail you could provide on how the working group that was formed in 2013 or 2014, how that working group was structured and how it evolved, and also there was a similar sort of evolution of thinking amongst the investment committee, I believe, in the last couple of years. So if you can just speak to that at a high level, that would be great, I think.
Yeah, I think the beauty of the working group was that all the constituencies of the college were well represented. And so we could get a community-wide buy-in to whatever recommendations this working group was going to come up with. I've seen it done at other campuses where the working group goes off and works for a year, comes back with recommendations which are, more or less ignored. And you wonder, well, why did they bother? But at Pitzer, it really was, a legitimate exercise in trying to achieve a consensus. A lot of the time we spent was what I call sort of devil's advocate. Obviously, we had to look at, what would be the impact on performance if we took some of these steps. But it was actually, keep in mind, we started the working group, the focus was entirely on divestment. And by the time we finished, we had an ESG mandate in our plan. And, that was a really, I think that shows the value of having a lengthy and deliberate conversation about this. As far as the investment committee, not surprisingly, investment committees, I think it's something I didn't mention, but people know investment committees are not static, right? Trustees are coming and going all the time. People retire and so on. And one of the things I wanted as the end result here was a process that would outlive, my oversight of this investment committee as well as anyone else's. Something that would create continuity through time rather than having portfolios be too heavily reflective of who happens to be the committee chair at the time. So there was an adaptation required, especially some of the members of the committee who'd been on the committee for, in some cases 20 years, wrapping their arms around the idea that we were getting rid of some active managers that we'd employed for a very long time. Some of them had good track records. So, there is that adjustment, but I think you have that adjustment anytime you try to move from the kind of conventional multi-manager, multi-asset class approach to a single comprehensive passive solution.
Right on. So Don, a clarifying question around the positioning of this solution in the Pitzer portfolio just came in, which I think would be useful to answer. The question is, is the solution implemented for 100% of the portfolio, and then also are there additional sustainable or impact-oriented investments that Pitzer has engaged in beyond the equity solution?
Okay, so this particular solution was implemented for 100% of the public equity portfolio. That is somewhat less than 50% of the total endowment portfolio. So this was specifically directed at the public equity side of the portfolio. We have, particularly in some of our private illiquid investments, made commitments to investments that are focused on sustainability themes. That's a small but growing part of our portfolio. But we have a lot of work to do on the other 60% or so of our portfolio in terms of thinking about these issues. Right now, our fixed income portfolio doesn't incorporate any kind of SRI or ESG tilt. But one day it might. It's one of those things where we're doing things one at a time. But yeah.
Thank you. So one other question for you, Don, and then I have a couple for Anil as well. So do you think the board was already primed to consider a more passive investment strategy, or and was it difficult to get over some active management conceptions or preconceptions?
At Pitzer, at least, the board as a whole had a fairly passive role in the investment management decisions, that it really delegate a tremendous amount of autonomy and authority to the investment committee. Obviously, the investment committee has to report regularly to the board about how things are going and what decisions they're making. The board has to approve any changes in investment policy. But I think in the case of Pitzer, the board didn't come at it with any preconceived notion of whether active was better than passive. So that wasn't an issue. That was probably more of a debate at the investment committee level. I will say too that the word passive is it's not quite as simple a word as it used to be, right? Because it used to mean, okay, a market cap weighted index like S&P 500. As I think Anil will talk more about, I mean, this index that we're using has a tremendous amount of activity that goes into determining its constituent weights. All of the the ratings that MSCI does on these 6,400 companies, the optimization, the rebalancing, and so on. But yeah, it wasn't much of a debate at the board level. I think the big debate at the board level was, on an issue like fossil fuel divestment. And I'll just say this and then be quiet. One of the great, I think, or important insights that we had in this process was realizing that a decision like fossil fuel divestment should not be made at the investment committee level. Because when it's made at the investment committee level, it's looking strictly at portfolio impact. But it's a decision that really needs to come from the board as a whole, because it's a policy decision that's reflecting the values of the institution as a whole. So that was an important insight.
That's very, very insightful indeed. Thank you, Don. So Anil, I think we've had enough questions, I think, about the sort of particulars of the index and how it performs or acts versus, say, the standard ACWI index. But I think it would be useful, perhaps, if you could talk through the back test that you guys performed. And I know you have some slides on that, which might help. Yeah,
sure. I think we can just advance a slide here, maybe one more. And I would just echo what Don had mentioned, is that we are seeing boards become much more comfortable with what were previously more quantitative techniques, such as optimization, that they might have been more shy or hesitant toward. But as Don said, if optimization is what reflects the board's policy or the endowment's values, then it's just a means to get to the end. And the end is, in this case, was a custom index that we had created for Pitzer. So let me just walk through that quickly. And as Don mentioned also, it uses two mechanisms. So this here is just a back test, a 5-year simulated back test from 2012 to 2017. So the first mechanism reduces exposure to firms with fossil fuel reserves. So it's going to start from a parent. That's the All Country World Index. So that's our kind of flagship global equity benchmark. It covers developed market stocks, emerging market stocks as well. It has around 2,500 names in it. So the first screen or the first index construction technique just screens out for those firms that have reserves, typically in oil and gas, coal mining, and electric utilities. So that data comes from the firm. It's updated on an annual basis using either information disclosed by the companies, other public records, or third-party data providers. The second portfolio construction technique uses the ESG score. So that is, we're going to maximize the overall portfolio level ESG score subject to the broad risk exposures of the benchmark. That is, we want to inherit the sector, the country, the currency weights that the benchmark, that is the All Country World, has, subject to a 60 basis point tracking error. And it turns out in this back test, it outperformed. That's shown here. Let's see, the 1, 2, 3, the fifth line down, the active return, this has around an 80 basis point annualized outperformance over the last 5 years. If you were to decompose where that outperformance came from, it largely comes from the underweight to energy firms, oil and gas producers. There's an underweight to the Russian ruble, to Russia as well too, given that country's exposure to the energy sector. Let me jump over to the next slide if we can, Nicole. So this just shows, what do we expect to see? We should expect to see an improvement, given that we're optimizing for it. We're targeting an improvement over the parent in terms of its ESG score. So I've highlighted those in red here, and think of that score as going from 1 to 10, 10 being the max. So the parent has a roughly the global equity universe has an ESG score that is about average. That is 5, 5.5. So we improve that considerably, the overall score. But importantly, that improvement isn't isolated to just one E, S, or G. In the second set of red boxes, it's really a improvement across all three of those. Lastly, let me just talk through for a second. The next slide just looks at what's the second impact on the portfolio. So if we could just move one slide, Nicole, and this should say carbon exposure at the top. So again, we are implementing our carbon view through two methods. The first is excluding fossil fuel, but as Don mentioned, we're actually getting another improvement in fossil fuel by doing that ESG optimization. So we expect to see an improvement here. So the carbon emissions tells us, so the first line here tells us that's just tons of CO2 emitted per dollar invested. What's my portfolio's normalized carbon footprint per $1 million invested? So we've improved on our parent benchmark. The carbon intensity tells us how efficient is my portfolio in terms of carbon emissions per unit of output. And lastly, the weighted average carbon intensity is similar. That's just what's the portfolio's overall exposure to carbon intensive companies. Let me pause there.
Thanks, Anil. Yeah.
Yeah.
That's great detail. I mean, I think the combined, the carbon reduction is a result of, in part, the exclusion of some fairly carbon-intensive companies that are also reserve owners, but it's mainly achieved through the ESG tilt, correct?
Yeah, that's right. I mean, one could ask, where does that 80 basis points, or where did that 60 basis points of tracking error come from? Why is Pitzer's index different than the all-country world? One of the main differences is it tends to be underweighted to the emerging markets. It's of course underweighted to the energy sector. It also tends to have hold firms with less earnings variability and lower risk firms. That is kind of firms that have lower beta, and that's expected. There is empirically there's a correlation between highly rated ESG firms and high quality firms. We tend to see that. So the index, the ex-fossil fuel ESG focus index, is actually picking up some of those characteristics as well.
Awesome, thank you. Well, I think we have time for about one more question, Anil, and we've had this is going to be a multi-part question, and it relates to sort of the bubble chart that you presented earlier with all the various actors doing a number of different things related to the adoption of ESG indices. So first of all, what I've noticed is that there are a number of investors that have adopted ESG indices as benchmarks, and then a number that have actually utilized ESG indices to implement fund solutions. Are those mutually exclusive decisions, or are they? Do they often go hand in hand, or usually go hand in hand?
Yeah, they would often go hand in hand. There would be a policy benchmark change to reflect, as Don said, a view that the organization has, and that might be implemented through a passive portfolio, or in some cases an active portfolio that takes a tilt on an ESG theme, but it's going to be compared to the policy benchmark in that case. One of the trends that we are seeing in the endowment and foundation space is using, as I said, more sophisticated techniques, be it optimization or be it ESG momentum scores, to create a policy benchmark. That is, we want to capture the broad characteristics of the global equity universe, but with an ESG tilt to it, with a subject to a tracking error. So, these are going to be indexes that hold many hundred names rather than a small subset, let's say 50 or 60 names. It just wouldn't make sense as a benchmark.
Interesting. I mean, are there any other trends in the in MSCI's work around the world,
Sure, yeah,
in the endowment space that you can speak to? Maybe endowment in the U.S. marketplace in particular. Anything that you've noticed?
Yeah, we can use this ESG data, and it's a rich data source. We can use it for index construction or portfolio construction. Another case for this is, and we're seeing asset owners, endowments do this, is can we start to evaluate external managers, right? Not just a passive portfolio, but an active manager using ESG analytics. So can we attribute the performance of some manager to their decisions to hold highly rated or poorly rated names? So that might be extending, say, classic Brinson attribution away from sectors and countries to ESG ratings. Right. So that's using, ESG data again as a risk and performance reporting tool. I would also say that there's an interest around how does the carbon themed portfolio or how does the ESG themed portfolio fit into the wider equity program, right? It's just one of several portfolios, not in the case of Pitzer, but in the case of many endowments, it's just one of several managers. So what is the impact of the carbon portfolio on the overall risk and return of the equity program? And that's going to be a function of how much capital is deployed to it, what is its tracking error, and then what's the correlation of the active returns of that carbon portfolio with the rest of the active managers. So one other trend that we're seeing is endowments and foundations are starting to employ, total portfolio risk analytics or systems to understand the sensitivity of returns or risk to each of those variables.
Awesome. Thank you very much, Anil. And that is all the time we have for today. Thanks to both of our panelists and all of the participants that we had join us here today. There will be a recording of this webinar available on the IEN website after this event, available to registrants. So feel free to download or access it after this live presentation is over. Thank you very much again, and we'll see you all out there. Thanks very much.